Hi everyone, welcome to automobile expenses. Let me tell you this one is going to be a bit detailed, lots of tax terminology coming your way. So if you're at the end of like a 4-hour binge session of watching training videos, stop here. Come back to this one tomorrow because this lesson needs kind of what we'd say some fresh brain, okay? Probably the most misunderstood and incorrectly accounted part of small business is automobile expense. It's kind of like the third rail of accounting because your clients, right, they want this expense so bad and will not stand for too much complication in getting it. They're sensitive to this. As a Halon accountant, we have to make sure that we do these things right. That means being extremely well educated on what is allowed and what is not. That confidence, when you know how to account for these things correctly, will translate to your advice and your clients will follow your plans. So watch this one over and over if you have to until it's memorized and you can kind of rock any questions. So my first question is going to be, what is an automobile? Not everything is an automobile. A forklift is not an automobile. It's not as obvious as you think, however. Any of these items that I've put into this slide could be a big problem for us when it comes to doing the books. They do qualify as autos. Each of these autos can be registered and driven on highways. And that is how I want you to think about automobiles. If it can be licensed and driven on a highway, you must think of it as an auto and start asking questions so that you understand the transaction, okay? For the work trucks pictured above here, the ones that have special equipment on them, I will say they are much easier to prove to the IRS that they're 100% work related. So this one here that's got the kind of the crane on the top and then this larger one that has the really big crane and machinery on here. The IRS isn't going to question whether there's a lot of personal and business being intermingled on these kind of trucks. However, the rest of them are going to be questioned. You know, the rest of them, the other autos need to be investigated hard because they can be personally driven and have a business element to it. Clients can be tricky when it comes to this. They know there are rules about how a deduction occurs. Yet when they're in the dealership, right, and buying the car and excited about it, that's not what's on their mind. They're not that worried about getting a tax deduction for it. So to get started, we had to understand what is an automobile, which I've kind of defined as anything that can drive on a highway that can be licensed. And now we're going to begin our analysis with a very simple question about ownership. And when it comes to ownership, we need to get to the bottom of it as it makes a big difference to the accounting. Either the business or the individual owns this automobile. Both cannot own it. Okay, so that's important to understand. Both business and personal cannot own an automobile. Business and personal cannot lease an automobile. So it's got to be one of these. As you remember from the accountable plan lesson, if the individual purchased the car, then we're going to go down the accountable plan road, right? If it's owned personally by an employee, the employee could be the owner, of course, right? If it's owned by them personally, we're going to go down the accountable plan road. If the business purchased it, then we won't. So how do we tell who owns it? Well, first, we will ask the client, really. We'll also ask for a copy of the purchase agreement. I've put kind of a sample, really simple purchase agreement. From a dealership, they're going to look much more complicated. Most of you are probably familiar at least with getting them. Whether the car is purchased or leased, we want this agreement. And this is how we can make sure whatever it is that they're telling us is accurate. I'm not saying that they're going to lie to us, but clients are notorious for saying something like this. Mr. Smith, how's that car titled? And they'll come back to me and say, I can't remember. I think it was in the business name. And Chris, listen, we only use it for business. We pay for it out of the business, so just make sure it's there. I can get you the miles, but all the miles are business. It's my work truck, Chris, blah, 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 right? I mean, that's what they say. Now, normally my motto is don't audit the clients, right? And you've heard me probably say that. I don't like to be an IRS auditor on my clients. I'm going to take their word at many things. We're not the IRS. But when it comes to autos, I kind of do audit them. And here's why. Because later, when that deduction is disallowed because they told me, because what they told me was wrong, they're going to blame me anyways. So being pushy here is really, I hate to be in a lose-lose situation, but they're going to blame me later or they're going to be mad at me now. So I might as well get it now so that I'm not in a situation where I'm going to have to pay something or I'm going to have to go through an audit or some kind of IRS issue because the client didn't tell me the right thing. So either I lose them now or I lose them later. So might as well do it now, right? So I follow up with something that goes a little bit like this. I totally understand, Mr. Smith, but we've got to have a copy of that purchase agreement so I can see things like the interest rate, the amortization schedule, the taxes and fees that are included in the payment. This will allow me to book it the correct way on the books. You know what I mean, Mr. Smith? So can I get that information as soon as possible? I cannot do anything with these transactions until I have it, meaning they're not going to be deductible until I have it. Then I don't let the client deduct it. I really don't. I put it into kind of a suspense account. Sometimes that'll be ask my accountant. Sometimes that'll be distributions. And I say, until I have that, I'm going to leave them out of the financials because I'm not sure, kind of how to do that transaction. Now, let me assume that he was right, that he did in fact title it in the business name. So to me, this is advantageous. We do want our clients to put things in the business name if they can. That should be our default advice, is put it in the business name if you can. What this means is that we're going to capitalize it on the balance sheet as an asset. The loan is going to be booked there too, because the loan should be in the business's name as well. So that's going to be a liability. And we're going to manage the payments and the interest expense through the business. And I'll get to that here in a second. But let's say that it's actually in the personal name, which will be most of your clients. This is when you have to force them down the accountable plan road, as I said before. You've got to make sure that they're doing this right. Do not slap this into the books despite it being personal, or just stay away from that. Otherwise, you're going to have problems, and it really should be a shareholder distribution. So let me show you what we do based on these two different answers, right? I've got if it's in the business or if it is personal. The first scenario is if the auto really is owned in the business's name. So if the business owns it, you're going to be doing some accounting work with the balance sheet. If the business leased it, the lease expense simply goes under rents on the income statement. You can break it out maybe if you want to, like crane lease or truck lease if you want to, but be sure to use the word lease. As you know already, Halon reads what these account names are. It reads like a person. And when it sees that, Halon's going to look up something called the lease inclusion rate so that the tax return is correct, because leases have to have a little bit of a subtraction taken from them because the IRS deems this lease inclusion rate mandatory. So if there's a lease on the financial statements, Halon will do all that work for you so long as you name it lease, right? You get it? For the purchased automobile, the purchase agreement is going to tell you some things, right? First, it will start with the purchase price, and it will give you the fees paid as part of the transaction, the loan balance, and any other factors to the purchase. There may or may not be information about the loan rate and payment. So if it does not have it, ask for the loan documents, the promissory note, the loan statement, or all of it. The idea is to get what you need to book this entire journal entry or this transaction that you're going to have to book every month whenever the payment is made. And I'm not going to detail in this video here what the different entries are. You can look that up online if you're not familiar. We can do a session on that inside the Facebook group or as an HFA meeting. But I will say this. If you are not sure what the loan rate is so that you can break the loan interest, the loan interest out versus the principal paid, you're going to have a big problem, because we need to set up a schedule so that our bookkeeping is much, much easier. What I've got on the screen here is I run a loan amortization schedule for a few years, right? And I keep it in the file so that we can have it quickly when we're coding the expense. When the payments come through the bank feed, we're going to show the principal and the interest amounts based on that schedule. You can also, you can also true this up at the end of the year if you wanted to, like book it all to the loan and then true up the interest and everything. But I think that's just as messy. So I like keeping it right all of the time, meaning we're going to book this transaction correctly every single month. On the screen is a version of an online loan amortization schedule. There are tons of them out there. Just query, online loan amortization schedule, and you're going to find it. Just use one and print it to the client's file or put it in QBO so you can just grab it quickly whenever you need it. And not every client's going to have something like this. So you can set up a system here where you can grab this file, use it, and you're not going to have to do it for everyone. You're going to have to just do it for the 5% of your clients that actually put automobiles in the business name. Trust me, it's more of a rare event than what I'm probably making it out to be here in this lesson. Also, a bit about depreciation. The depreciation can be booked each month or at year end if you like. Name it depreciation, however, and Halon's going to make sure it's correct on the tax return. If you're not sure what to take as depreciation, we have a calculator inside Halon that will help you, and I'm going to show you that here in a few slides. Only about 5% of my clients actually have autos in the business name. That's kind of what I was getting at before. Only about 5% of my clients do this, and those autos are 100% business, so that makes it really easy. But wait, right? 100% business? What if my client uses the business automobile for both business and personal? That's what happens then. I will tell you, and I'm going to get to that here in the next slide, I will tell you that of my clients that do this, it is easily understood that it is 100% business because it's like that crane machine or something. They don't drive it around otherwise. But what if the business owns it? It's a business asset, and they are driving it around some personally. The next slide is all about what to do with that. So the employee is using the business-owned vehicle and is driving around for some personal use too, right? That makes sense? Okay, no problem. One thing I want you to remember, the business deducts the full amount. Okay, so the business transaction doesn't change. We're not going to mess with the business financials. Some people would say, well, you need to actually reduce what's on the business financials for the personal side. We're not doing that. Instead, we're going to gross up the employee's wages for the personal use. See where I'm going with this? That gross up counts towards the total compensation needed for Halon, because we're always trying to find reasonable compensation, and all of our owners have some kind of salary they have to pay. So we're going to make sure that part of our wages are to compensate for the personal miles. Now remember, this is on a business-owned vehicle. So if they own it personally, this doesn't apply. But on a business vehicle, we're going to gross them up for the personal miles. We're going to use an IRS-approved method, I've got this on the screen, called the annual lease valuation. It requires the use of an IRS publication called the 15B. And there's a table from the 15B that I've included on the slide, and I've included the full 15B in the downloads to this lesson. This table is going to tell us what that gross up should be. So here's the example on the screen. I'm going to say that I drive a car that is valued at $45,000. You can use Kelley Blue Book or something to figure that out each year. Next, I'm going to ask the client how much is personal miles. They're going to have to turn in miles that verify this, but I'm going to ask them ahead of time, and I'm going to take their word on it for now. So their proof is going to come at the end of the year when they turn everything in. But for our example, we're going to expect to drive at 15,000 miles, and the client has told us that 5,000 will be personal, 10,000 will be business. Of course, your client's going to come back and be like, well, I'm going to drive at 15,000 miles and probably 1,000 is going to be personal, and say, hey, there's no reason to skimp on this, okay, because we're going to gross up your wages, which we already have to do. So don't be fake about it. Just tell me a reasonable number. So as you can see, we've got $45,000 on the car. And when we look up in the table here, I've got my pointer now, the 44 to 45,999 value is 11,750. What the IRS is saying in this table is that the lease value of that car would be 11,750 if the business need to lease it out to somebody full time. Okay? And his personal use percentage of the miles, since he's driving at 5,000 of a total of 15, personal miles are 33%, right? So the value of the personal use is 11,750 times the 33%, and you get $3,877.50. This would be the amount of the employee's salary that's attributed to business use of the car. So we're grossing up their pay, assuming their pay was zero. We're going to gross up their pay $38,777. Now let's say that in this particular business, the Halon matrix and all of the work you did on the matrix said the total compensation for this owner should be $38,000. Well, your other compensation is going to be $35,000 or $34,000, and then part of it's going to be this $4,000 for personal use, right? That's going to be in their salary. I also show that this is a FICA withheld amount, so there's no exemption. This isn't like medical insurance where you can gross up their salary for it, but they don't actually pay FICA on it. This is one where they have to pay all the taxes on it, just like regular salary amount. Now, unless the business makes very little, as I said before, the owner was going to have some kind of salary. So I don't want you to skimp on this. Don't make it over 50%, like the personal miles percentage. Don't make that over 50% or we're going to have other problems. But don't make it 5% because there's no reason to take that kind of risk whenever we're booking this stuff. Does that make sense? If the company leases the car, okay, it's not bought, it's leased, but it's the same situation where the employee's using it some. Just ignore the 15B table and just use the actual lease payments and do the same calculation. That's how we do it. So the company gets to deduct the whole thing, and then the employee is grossed up for the personal use of the car. Make sense? If it doesn't, ask some questions in the lesson, but I hope it makes sense. Let's explore now if the car was actually in the employee's, and could be the owner's name and not the business, right? So this is how we treat business-owned autos. Let's take a look, kind of summarize what we do if the employee, the owner, owns the car. So if the car is in fact not in the business's name and is owned by the employer or the owner, then nothing goes on the business books about the car. Do not capitalize the car. Do not load the loan onto your books. Don't do any of that. This is simple. It is not owned by the business nor a business asset. You will get questions from clients like this. What if I contribute the car to the business? Or what if I gift it to the business? What if I give it to Teresa and then she gives it back to me and then I give it to my son and then my son gives it to the business? You're going to get all kinds of questions about that. Here's the bottom line. If the title is not in the business name, then it does not go on the business financials, period. They can do whatever they want to, but at the end of the day, the only way it goes on the business financials is when they turn in a title to you and it has it in the business's name, okay? Most of the time, putting autos in the business name is tough. It means different insurance. It means commercial insurance on the vehicle, different kinds of loans, different kinds of financing whenever you go to buy it. And it's usually, at the end of the day, it's more cost. So if the car is in the personal name, then we're going to hammer the accountable plan, as we talked about in the previous lesson, the first lesson of this module. On the screen, I have the section of my accountable plan template that deals with automobiles. If you complete the miles section, then if the car is owned by you, there's just really a couple of tricky parts here. One is the loan interest, okay? This is where I get that amortization scheduled again and keep it handy to fill it in. So I'm going to fill in what the auto loan interest amount is. We get paid, to do these accountable plans, we get paid something like $60 a month to do all of this. So, we're good with that. The second part, the second tricky thing is depreciation. And what I'm going to do now, I'm going to pull up the depreciation calculator that's inside Halon and show you kind of how to look this thing up. Okay, so here is the Halon depreciation calculator, and you can find this at depreciation.halontax.com. You don't have to be logged into the software, even though it's in the software too. And what we're going to do is we're going to say our client has purchased this car, and the purchase date is 02/01/2018, and it is a car, and the price was $45,000, remember? And we can see how Halon immediately starts to populate this. Because it's a brand new car, there's no previous year Section 179 or previous year bonus depreciation claimed, which means in 2018, the depreciation amount is going to be $10,000 for 2018. Now, I'm going to cover this in the next lesson that's coming up called depreciation. There's actually an additional $8,000 that can be added to this 10, bringing it all the way up to $18,000 if we want to use bonus depreciation. And in most cases, actually, you will. The reason I don't have it in this actual piece of software here is because legislation hadn't quite given us an idea of the way that that bonus depreciation was going to work out for the rest of the years. It's complicated, but we're going to be making this $18,000 within the next month or so. So I would say by the time you get to use this, this is going to be 18 instead of 10. Anyways, what we're going to do now, and I'm gonna downsize this now that we know what our depreciation number is. I'm going to downsize this and go back over to our accountable plan spread. So for that depreciation amount, if we were using 10 or 18,000, depending on whether we're using bonus depreciation or not, let's say we're using the 18,000, we're going to take, if this is a quarterly spreadsheet, we're going to take 18,000 divided by 4 and put it right here in that depreciation column here. Does that make sense? And if the car is leased, then we're not going to put anything for interest or depreciation. We're just going to enter the lease payment, which is what I've actually populated in the image, is whatever the quarterly lease payment amount was. As discussed in the accountable plan video, this gets reimbursed to the employee each month or each quarter and is shown as an expense in the journal entry part of the tracker. So there's a second tab in this tracker that shows you what the journal entry needs to be that goes into your books. So don't make this, super hard. Either get paid to do it for them, right? Either get paid to do the accountable plan for them, or make sure that they do it themselves and that make sure that they do it right. And if they're not doing it right, it's not really your job to train them. Say, this isn't right. Take a look again at my accountable plan email. If you're wanting to do this on your own, we got to make sure you're doing this thing right. Kind of make it like, hey, I do this for a living. I'm not really here to teach you how to do it. I mean, that's not really our job. And so the whole idea is to get them back over to that package. But if they're just not willing to do that, force them to do it right. You shouldn't be spending a lot of time on this if they're not paying you to. Don't be mean. Just be tough on them. Does that make sense? From this perspective, you're both on the same team. You just want it done right. Now, one thing you may have noticed is that I have not yet mentioned the standard mileage rate yet. I'm going to get into that now. So let's jump into there. So I've left mileage until now because in my experience, it is not usually a good option compared to the actual expense method. If you use the accountable plan tracker that we provided in the accountable plan section, it is considering both the mileage method and the actual expense method. The mileage method is really simple. You just take the government IRS rate, which they publish each year, times the number of business miles driven, and that's the deduction. The rate usually fluctuates. It usually fluctuates each year, but it's usually around like 55 cents a mile, something like that. However, with the new depreciation rules, the new rules that came out with the 2018 tax law, taking depreciation and actual expenses will most likely be the right move if the business owns the car or if the employee owns the car. This is because it's just much more expanded. We used to have to follow something called the luxury auto depreciation limits. And for expensive cars, it might mean that you don't really get much of a deduction. With this new law, the auto depreciation is very lucrative. We'll get into all of that in the next lesson. I do want to cover a couple of the bullets that are on the screen right now, however, and one has to do with Section 179. You cannot use the mileage rate if you have used Section 179 to depreciate the car, or if you've used bonus depreciation. And we're going to get into this a little bit later, but imagine you have an SUV that's over 6,000 pounds, and you are allowed to Section 179 the entire value of the vehicle, meaning you expense the entire vehicle in the first year if you want to use that. Well, then in the second year, if you switch to the mileage rate, you're going to kind of get additional expenses that isn't really fair. So the rule is, if you use bonus depreciation or Section 179, and again, we're going to go into depth on this in the next lesson, You cannot use mileage later. So just remember that. Also remember that S Corps can't receive a mileage rate. And like the bullet says, they can, but the cost of the car has to be less than like $17,000 or something. And I don't know about you. I don't think many are driving cars that cost less than 17 grand. But if you were, you could take it. Otherwise, if the business owns the car, the mileage rate, the mileage method is not available to you. So a couple of things I wanted to show, but again, I don't think you're going to be using mileage that much, so I'm not going to spend a ton of time on it. Let me move on to another topic that I think you will have to kind of use and utilize. And that is how you are going to talk to clients and question clients about a new automobile. And as you can see, we've got Liam Neeson on the screen there, and I thought that was kind of a funny picture. It made me think of my clients whenever I'm telling them that they really should have probably talked to me. It's very likely that you will be the last to know about the new car or truck or vehicle. While the client may negotiate for months, then make the purchase via a loan, then drive it for a month, you'll hear about it when they make the first payment. And you'll say to yourself, well, what is this, right? What is this new thing? I need to talk to the client. And when you contact them, for them, it's going to be really old news. And they won't really want to talk to you much about it. Making a payment on the new car isn't really that much fun, right? It's not nearly as much fun as buying the new car, but they've had it for a while now. And so the approach to the client and the approach you take needs to be done in the right way and create kind of the most of that interaction. And I wanted to talk a little bit about it. The number one thing to plan for is that they purchased the automobile in their personal name. Go into it believing that that's what they did. And you're going to have to be recommending an accountable plan if they don't already utilize one for the car that they drove before this. So have your game plan with that ready. Talk about accountable plans, that there's no deduction without it, that you have to get a package and upgrade your package for us to do all of that. Otherwise, you got to do it on your own. But before they'll bite on it, you'll need to explain how all of this works, why they don't get a deduction if it's in their personal name, yada, yada. So I'm going to kind of simulate a discussion. I thought that might be beneficial and kind of go through how I talk to clients. So imagine that I have called the client and I'm going to kind of be talking to him. I've got him on the other line. Hey, Tammy, it's Chris Reagan. How are you? Good. Listen, we saw a transaction come through the bank feed today and looked like a new car, or a new car payment at least. Did you buy a new one? Awesome. Yeah, that's great. Do you just love it? That's great. New cars are fun. Listen, let me ask you a couple of things about it, and I'll let you get back to work. First, is that titled in your personal name or the business name? Yeah, it does depend. You're right. It is going to make a difference on the deductions. Yeah, I know, but we can figure that out either way. But it sounds like it's in your personal name, right? And really what she was trying to do is, what answer am I going to give you that's going to make sure I get this tax deduction? Just keep pulling it out of them. And when they finally say that's in their personal name, say, okay, good. And is it... Tammy, is it leased or did you purchase it with financing? Okay, you purchased it. Great. So here's what I need. I need a copy of the paperwork you signed at the dealership. It should be called a purchase agreement or a purchase contract, and I also need a copy of the loan docs. Yep, you can just send me everything. You can send me the whole package if you want to. That's fine. Good. Now, for the deduction, I have to make sure we start running something called an accountable plan. Do you remember me talking about accountable plans during the onboard? Yes, and we never did it because you said you didn't drive the old car that much for business, but it sounds like this one will need to run. You're wanting to run this through the business, right? You're wanting to take a deduction of some kind for it? Yeah, I figured so. So it sounds like this one's going to need it, and we're going to need to do that accountable plan part. The accountable plan requires that we prepare some paperwork each month and do a transfer from the business to you to pay for the business part of the car and some other things. Basically, you're submitting an expense report, as you remember from the onboard meeting, and we're reimbursing that. Is this something that, putting that report together and kind of doing those reimbursements, is that something you want to do on your own, or are you thinking you might want to have us do that? Because if you want us to do it, we have an add-on that we can add to your package. It's about $60 a month, and we prepare all that for you. We calculate everything for you. We tell you what you need to transfer, and really all you have to do is the bank transfer itself from the business to your personal account. Okay, so yeah, I get it. It's a lot. Yeah. So what she's doing here is she's, and I've broken away from the conversation kind of, what she's going to do at that point is kind of back up and be like, wait, I'm confused. $60 a month. Why do I need to do this? I mean, can't we just write off the car? I always wrote off the car with my other account, all that kind of stuff. So you're going to have to back up now and be ready for it and take her through all this accountable plan stuff. So here's what I say. Okay, Tammy, let me summarize and kind of go back to why we have to do this. So because the car is owned by you personally, the only way to deduct it is through something called the accountable plan, which is an expense report. The IRS will not allow us just to slap the car into the business. If the business owned it, we could, but not a personal car in your personal name. So to take the deduction, we have to, run this plan. Now, at this point, Tammy may blame me for not telling her about owning cars in the business name. That's her first instinct. Well, I didn't know it needed to be in the business name. I wish you guys would have told me that. I would have put it in the business name. So when you're onboarding people, make sure that you try and cover this kind of thing. That they should be contacting you before they make this kind of purchase, which is why I put that on the screen, so I should have called you before I bought this car. Yes, you should have. I would have told you to put it in the business name. But when you're onboarding people, try and make a big deal about it. Try and make a big deal that they can remember, because as I go back into this conversation, watch what I'm going to say. Tammy, in the onboarding, we talked about it, but we also talked about anytime you're going to make a large purchase like this, we want to chat with you first, right? But do you remember we talked about the accountable plan? It was purple. We showed you all the different, we talked about the home office deduction. Yeah, that was what it is. Well, now this is part of why that is so important. And besides, to do it in the business name, to put your car in the business name, you would also have to insure it in the business name. That would cost far more, I can assure you, than the $60 a month it's going to cost you to have us do the accountable plan. Commercial insurance is an arm and a leg. So yes, I know, I get it. Let me send you the documents to get you started, and we'll get your plan going at once. Now, and I'm back off the phone. That's got, I kind of just ram it through, because they're not going to do it on their own. I just say, hey, you need this upgrade. We're going to send you all of this stuff, and you're just going to start doing it. It was a bit of a detailed conversation, right? But you're going to have them. And how they go down depends on how you onboard. This idea would not have sunk in for you. Like if I would have covered this during the onboarding lesson, it would not have sunk in like it can sink in now, where you see this situation and you go, oh, this is why I got to hammer accountable plans and all of this car stuff whenever I onboard somebody, because it can come back and bite you when they do something like this. Every client must be told about automobiles, accountable plans, and owning things in the business name, so that later you kind of have a defense to the blame game, right? Does that make sense? Okay, let's move on to the next topic here. So when it comes time to sell the car, a business-owned car, the client will want to pay attention to how they sell it. This is mostly done by evaluating the basis that is remaining in the car. Basis is really simple. Don't get freaked out here. Basis is simple. It is what you purchased the car for minus all the depreciation taken over the years. So if your basis is higher than what you can sell it for, when you do sell, you're going to have a loss, right? If your remaining basis is $20,000, but you sell the car for $10,000, you have a $10,000 loss, right? If just the opposite, if you have a basis that's higher or lower than what you can sell it for, you're going to have a gain. And here's the point: if you're going to sell the car at a loss, right? If you're gonna take a loss on it, then go ahead and sell the car. You don't have to try and do some kind of trade on it. So if we can recognize a loss, we should do that because it helps us on our taxes. But if your basis is less than fair market value, like you depreciated the whole thing, right? Like that 179 example I just said. First year you depreciate the whole thing, so its basis is zero, and then you're going to sell it for $5,000. You'll have a $5,000 gain. That's bad. We don't want that because that's going to increase our taxes. So here what we want is we want to trade it in. That way we're deferring the gain till later. It's called a like-kind exchange, and the way that it works is really simple. I'm going to show you right now. So just realize if you're going to take a loss, go ahead and sell it for cash, take the actual loss, and then go buy another car. If you're going to see a gain from selling it, think about a trade where you can do a like-kind exchange. Okay, let me tell you about the like-kind exchange. And don't be intimidated by like-kind exchanges. They're really not too bad. On the screen, I have a calculation and a worksheet you can use. So because the basis of our car is so lower than what we can trade it in for, this keeps us from recognizing the gain. But that gain is sort of going to be transferred to the new car. So let me take you through the calc that's on the screen. So first, we enter the original cost basis of the car that we are trading in. So the original cost basis was $45,000. And then we take a look at what the total depreciation taken on the car was. So that's $12,000, okay, in this example. So the adjusted basis of the car, right, cost minus depreciation is $33,000. Whenever we trade this in, the new car, the new car required us to put $10,000 more down. So we were giving them our old car, plus we were having to put $10,000 into the new car. That means the basis of the new car is going to be this 33 plus the 10 we put in at $43,000. The depreciation allowable on the original car was $12,000, so the new depreciable basis of the new car is $43,000. Here is another way to kind of look at that. But here's what really happened, right? The car was probably valued at something higher than $43,000, right? Because we were able to sell the car for more than what our basis in the car was. So we gave them the car and the $10,000, but we didn't get to benefit from any of the increased cost of that car, because we have to go basically off of all of this basis information. So imagine that the new car we were buying was about $60,000 and we were getting $50,000 for our trade-in, right? Okay, let's use that as an example. In a traditional sale, we would have paid $17,000 in gain. The difference between the $50,000 that it's worth on trade-in and the $33,000 that is our basis, right? Then we would go, so we'd have to recognize the $17,000 gain. Then we would go buy the $60,000 car, and the basis would start at $60,000. But with this, we're able to avoid the tax right now. But our basis isn't $60,000 in the new car, is it? It's $43,000. It's the difference of that $17,000 that we would have had to pay tax on the gain. It's the difference between the $50,000 that the car was worth and the $33,000 that it had in basis. If that doesn't make sense, re-listen to this a little bit. I know that it can get a little bit confusing, but just at the end of the day, know this. What we're really trying to get people to do is if they can sell their car for more than the basis, if they're doing heavy depreciation, always have them traded in and doing like-kind exchanges whenever we are moving the car forward. And if you need help with this, you can always call Halon, and we'll kind of help you figure out what the new basis of the car is so that your bookkeeping shows the right basis and that our tax return shows the right basis. Make sense? Don't worry about it. Most of the time, this isn't a complicated thing, and usually people keep rolling this forward to the point where, they'll buy another car and another car and another car, and the basis just keeps getting lower and lower and lower, and then eventually they shut down the business or they retire, something like that, and they have to pay gain on all of this tax stuff. But that's not going to happen for a long time. So just know that if they're looking at gain on a car sale, that they should do a like-kind exchange. Now, what about if I own the car personally, right? Like the business doesn't own it and I own the car personally and I sell it. No need for all of this then. So most of your clients aren't going to be doing like-kind exchanges. This is if the business owns it. If we're doing the accountable plan and they own the car personally, you don't have to do any of this. That is a personal asset. So long as the accountable plan was in place, the reimbursements are not taxable. So just sell it, trade it, do whatever you want. But that's what you're going to do for most of your clients, right? Because they're all going to own these things personally. But like so many things with the new tax law, as it is important that you know how like-kind exchanges work, you now also need to know that we can no longer use them. In 2018, Congress took away our ability to do like-kind exchanges with vehicles. You can now only do them with real estate. They're also known as 1031 exchanges. However, that's probably okay because of the automobile bonus depreciation, and then for larger trucks and SUVs, being able to fully expense them, you're probably not going to be hurt by this. Going forward, when you sell or trade a vehicle, you have to recognize the gain. You can then pretty much offset it by the new depreciation that you're able to take on the new vehicle. Does that make sense? You're probably not going to have $18,000 worth of basis left on some of these things, like gain left on some of these things. So whenever you trade in a vehicle, maybe your basis is lower than what you're trading it in for, but I don't know that it would be $18,000 lower. Maybe it could be, but this is kind of the thing we're stuck with. Now, this could change by the end of 2018. I think Congress may try and sneak in the ability to still do these at some point. I think farmers probably would be the reason. I don't know if farmers like necessarily taking accelerated depreciation in years when it doesn't really help them. So maybe their lobby will change Congress's idea of this. But for now, these are off the table. So I wanted you to know what they are, especially if you've had clients use them in the past, but can't use them for now. I'll let you know if you can. And now we can jump into our action plan. We're all done with this lesson, and it starts with find out who owns the car and what the financing looks like. You're not going to be able to book these transactions without really diving into the details of this. Do not let clients keep that information from you. Push the accountable plan when necessary. I think we've all realized that's going to be a theme of working with small business owners, is they do need to have accountable plans whenever they own things personally, and especially if they want to utilize home office, commutes, all that kind of stuff. For purchase cars with loans on them, keep the amortization schedule handy. Have that somewhere where you can grab it whenever you're doing your entries for depreciation, for amortization of the loan payments, and you'll have everything you need and can do it very fast. And let the spreadsheet, the accountable plan spreadsheet, calculate the best automobile deduction. Use the depreciation calculator, which, as I showed you, is at depreciation.halontax.com. And then finally, while we learned like-kind exchanges, they are not available to you in 2018 thus far. That could change at some point, but right now, they are not available to you. Thank you for watching this installment about automobile expenses. I've got more for you. We've got another lesson coming up here. We've got parent subsidiary and then depreciation too. So I will see you in the next videos. All the best.